Good afternoon, everyone. My name is Christian Musbach. I'm a senior in the AIM program covering domestic real estate. Today, I will be pitching QTS Realty Trust, ticker QTS. Before diving into my recommendation, I will first begin with my screening process. I want to find a REIT that invested in data centers due to the demand trends in this space. There are a limited number of data center REITs. I chose QTS due to the relatively low amount of debt and strong occupancy rates. Now, I'll give an overview of QTS Realty Trust. QTS Realty Trust is a real estate investment trust that specializes in acquiring and developing data centers. In order to be considered a REIT, they must pay out at least 90% of their taxable income to their shareholders. If they pay out the 90% or more, they are not required to pay corporate taxes. QTS currently owns 25 data centers that span across the United States and Europe. The company currently owns data centers in Virginia, Georgia, Illinois, Texas, Oregon, New Jersey, Florida, Kansas, Arizona, and California. Also, QTS owns two mega data centers in northern Netherlands. It derives 96.7% of its revenue from rental income and 3.3% from other. The other revenue includes management and development fees. Overall, the company's strategy is to acquire low-cost properties and develop data centers. Now I'll go on to my recommendation. QTS provides data center solutions and operates in three segments. Those segments are hybrid colocation, hyperscale, and federal. Hybrid colocation are consistent, diverse, and make up the majority of revenue at 67%. These customers are located in multi-tenant environments within the data center. The hyperscale side of the business includes customers who are fast-growing and have longer-term contracts that range from 5 to 10 years. These customers require a larger footprint because they require large amounts of power. Lastly, the federal customers are the smallest revenue source for QTS, but they have many long-term drivers due to the high barriers to entry. Since 2012, QTS has invested in the security and infrastructure to support these federal customers. These investments have allowed them to be one of the few data centers to support this type of business. This allows QTS to be more profitable due to its pricing power. The company has been able to increase revenue at a 13% CAGR since 2017 and increase its adjusted EBITDA margin by 550 basis points to 53.8%. One of the major reasons for this growth is its service delivery platform, SDP. This technology, which is free to customers, allows them to remotely interact with their data. Also, QTS is able to be selective in which deals they sign in the hyperscale segment, which drives higher returns. Typically, this segment has lower returns than the hybrid colocation segment. They take a balanced approach by leasing a third of the facility to hyperscale customers and the remaining for enterprise customers. The selectiveness in hyperscale deals and diversity among tenants allows QTS to drive higher returns. Continuing, QTS also drives high returns by limiting the risk of building in a new market without pre-leasing the space. An example of this is them entering the Hillsborough market, where they pre-leased the first 4.5 megawatts to a hyperscale customer. Lastly, the ample amount of liquidity has allowed QTS to continue to invest in its business. The company revised its capex higher for the year and achieved $21 million in incremental annualized revenue for the quarter. This is the second consecutive quarter of beating its goal of $15 million per quarter. Due to QTS's strong customer base, a solid portfolio, and an increase in demand for data centers, it is recommended that QTS Realty Trust be added to the AIM Equity Fund with a price target of $73.59, representing a potential upside of 15.44% with a 2.78% dividend yield. I will now go on to my drivers. The first driver that I'll cover is data usage tailwinds. The demand for data centers is growing and accelerated during the pandemic. In 2Q20, QTS saw an increase of 85% in recurring revenue signed from IP bandwidth upgrades, meaning existing customers are expanding. According to data from QTS, it is expected that the outsourced data center market share is expected to double by 2023 to 66%. The pandemic accelerated the usage of data centers with the work from home trends. This has grown the demand for SaaS platforms and infrastructure platforms. According to Statista, the global data volume is expected to grow at a 27% CAGR through 2025. Another area in the data center space that has seen strong growth is within connected devices. This area is expected to grow at a 17% CAGR through 2025, which is driven by the Internet of Things, self-driving cars, and 5G. Given the diverse exposure of QTS's tenant base, the company should benefit from these tailwinds in the foreseeable future. Now, I'll touch on the company's diverse tenant customer base. The cloud and IT services and content and digital media industries account for over 50% of QTS's revenue. The cloud market is expected to grow at a 51% CAGR through 2023. This demand will help to offset some of the troubled industries that QTS is involved in. However, despite some of these industries being hurt by the pandemic, a small number of the customers who asked for extended payment terms have since resumed payments. This disruption by the pandemic has caused many industries to digitalize. This digitalization period requires data centers, which is why QTS's occupancy is up to 93.1% from 91.3% at the end of 2019. Lastly, the strong capital structure that QTS has. QTS currently has $1.1 billion of liquidity, which will allow the company to make necessary investments to keep its competitive advantage. The previous guidance for CapEx given the 1Q20 earnings call was $550 to $600 million, but the increase in liquidity has allowed the number to increase. Now, QTS expects to spend $650 to $750 million in total for 2020, with 75% of the capital development plan directly tied to signed leases. The focus on the resilient capital structure allows QTS to de-risk its portfolio. Currently, 70% of the outstanding debt is at a fixed rate with no significant debt maturities until 2023 and beyond. Now I'll touch on my valuation. In order to reach an intrinsic value for QTS, a net asset value model is constructed. Using a capitalization rate of 4.75%, an intrinsic value of $72.24 was reached. Additionally, a 10-year discounted cash flow model was constructed. Using a terminal growth rate of 1.5% and a WACC of 5.06%, an intrinsic value of $80.28 was reached. Finally, a price FFO multiple was calculated. Using a 2020 estimated FFO per share of $2.67 and utilizing a blended average price to FFO multiple of 23.55 times, resulted in intrinsic value of $62.91. By weighting the models 40, 40, 20 respectively, a price target of $73.59 was reached, resulting in a potential upside of 15.44%. QTS also pays a dividend yielding 2.78%. Now I'll touch on risk. The first risk I see to QTS is our customer concentration. The top 10 customers for QTS currently represent a third of the total revenue. If a major customer were to declare bankruptcy, this could have a significant negative impact on QTS's revenue. In the first quarter of 2020, customers that represented around 5% of the revenue requested payment relief. However, in 2Q20, a number of these customers have resumed payments. The second risk I see is our industry exposure. QTS is exposed to multiple industries that were hit the hardest during the pandemic. These industries include retail, transportation, hospitality, and oil and gas. These industries account for less than 10% of QTS's revenue. With an uncertain recovery in these industries, this could pose a major risk to QTS if these businesses did not survive the economic downturn. And lastly, oversupply within the industry. The data center industry is currently going through an expansion period. Utilization has remained high over the past few years, which has driven development. If the industry becomes oversupplied due to the high rate of development, this would hurt QTS's pricing power and overall health of its business. Now I'll touch on management. Chad Williams, on the left, is the chairman and CEO and was appointed in 2005. Prior to founding QTS Realty Trust, Mr. Williams was the CEO at Quality Group of Companies, QGC. On the right-hand side is Mr. Burson, who is the CFO and joined in 2013 with more than 20 years of investment banking experience. Overall, QTS Realty Trust is in a solid position to capture the strong demand trends in the data center space. The company's competitive advantage comes from its service delivery platform, STP, which allows customers to remotely interact with their data. Also, QTS's focus on the federal vertical is a key differentiator due to the security they have to secure those jobs. This allows them to be roughly 2 times as profitable with the federal customers. The combination of a strong tenant base, solid portfolio, and increasing demand make QTS a solid buy. Thank you for listening, and I look forward to your questions.